Good day, guys. Welcome to another exciting episode of the WealthWise Show. I'm your host, the Wise Investor, and join me as we navigate the world of personal finance and equip you with the knowledge and tools to make wise financial decisions. Now, let's dive into today's episode of the WealthWise. Alrighty. Welcome to today's episode, guys. At the start of the episode, just want to clarify, guys, that all the information presented by me, the Wise Investor, is for educational purposes only. It is not meant to be used as financial advice. I do not give financial advice on the internet unless you're a client of mine. But yes, so take everything I say is for educational purpose only. It's for you to learn and not act on. So today's episode, I wanted to talk about how you can utilize, just kind of a callback to our first episode about bonds, but not just, U.S. Treasury bonds, but corporate bonds, municipal bonds, the different types of bonds that you can mix and match in your portfolio to give you I would say a safety net, essentially. So let's go into the U.S. Treasury. So this month, now I'm recording this, not the same week you're probably going to be hearing this. I'm recording this in June, June 23rd to be exact, on a Friday. I think it was last week, the Federal Reserve Chairman Powell, him and the board or the committee decided not to raise rates, which is, great. But keep in mind, we're still in a high interest rate environment. So if you have credit card debt, if you're trying to purchase new debt, like, with a loan or things like that, it's going to be expensive. Even if the rates are not going down and are not going up, it's still going to be an expensive rate. So one of the things that I like to teach people is, okay, yes, debt might be expensive, but it's also expensive for your favorite companies and the U.S. government. So when interest rates are being raised, typically what will happen is the interest rates on U.S. Treasuries go up as well as the cost of debt for corporations. And one of the things I want to mention is growth companies, tech companies to be exact, they live off of debt. Like, a lot of them thrive, off of loans, essentially, to innovate. So, think about that. If they have to if they have to loan money and get into debt, who are they loaning money from? Well, a lot of times these corporations issue bonds, and you can buy those bonds. You, the viewer or the listener, can buy those bonds and collect interest on those bonds. But I'm getting ahead of myself. Back to the interest rate talk. So you got the Federal Reserve, at the time of this recording, they paused, and they did say that, there might be appropriate for a couple of more rate hikes this year, which is nice if you are an owner of debt. Not if you, owe somebody, but it's nice if you owned it, essentially. So why would that be nice? Well, it's nice because, you get interest on a asset that has very low risk. So if you're getting, let's say 5%, if you're getting 5% on a U.S. Treasury bill or note, which is, the debt that the U.S. Treasury issues out, if you're getting 5% on that with the promise of getting your principal back at the maturity date, which can be anywhere from 1 month to 30 years. But typically, if you're talking about short-term debt, they're going to have the highest interest rate at the time just recording. You're going to have the ability to sit out on the market volatility, because right now the market is going down. We hit some highs. And now, we're tracing back down. And one of the things that I like to teach people is equities are nice. I love equities. That's how you build equity. Buying stock in corporations allows you to own those corporations essentially. But a lot of times, those corporations are have a risk, systemic risk. Now, what is systemic risk? Systemic risk is systematic risk. Is the system, like it's unavoidable. Like if let's say a company is doing really really well, but not legislation, well legislation too, but let's say like tech company, a tech company is doing really really well, but the interest rates start going up. It doesn't matter how well you're doing, they're going to get hit by that. No matter how good they are, to insulate from systemic risk is really difficult. So that's one of the things where it's like, okay, if you're only in equity stocks and you don't have anything to protect principal, at least alleviate some of the stress of the downward terms or downward times, then your portfolio is not diversified. Some people think diversification in portfolio is having, tech stock growth or tech stocks, consumer discretionary stocks, industrial stocks, financial stocks, but you still have stocks at the end of the day. So how's that diversified? You're still exposed to, not only the unsystematic risk, the business risk of the companies you're purchasing, but you're exposed to the systematic risk. And that's where people don't understand the word diversification. So when you want to diversify your portfolio, bonds are a great asset to think about. Talk to your financial advisors. Do your research. Remember, this is for educational purposes only. I'm not saying go out and buy U.S. Treasury bonds. I'm not saying that at all. But what I'm saying is think about, protecting your gains. So right now, we've hit 52-week highs in a lot of stocks in the market and even the S&P 500. If those are gains that are like, you want to protect, how are you going to protect them? Some people might say, well, you can sell some of your stock to get the gains, and okay, that is one way to do it. But what do you do with the money that you just made? You just let it sit in your brokerage account, and that's where bonds come into place. Because if you think about it, if you have the ability to earn 5% interest on cash that is just sitting there in one of your accounts, then why not take the profit that you just made and earn interest on it while you wait for the market to cool off and then go back in? And you see what I'm saying? See where I'm trying to paint this picture? Now, of course, I'm not trying to, like I say, do everything for everybody. I'm not trying to do that. I'm not trying to hold your hand and be your financial advisor because, like I said, I don't give financial advice. But this is one of the things where, education is important, not just literacy. And I know people might say, well, isn't that the same thing? They're similar, but you can be literate and not have education. So, and what I mean by that is, well, I guess let me change up the word education. I mean knowledge, like wisdom. I guess that's a good term for wisdom. You can have the knowledge, but not the wisdom. So, yeah, you guys hear me? I'm working this out as I speak. But yes, so me as the wise investor, I want to impart wisdom on my listeners and people who, might have the information but don't have the wisdom to apply the information. So back to the bond talk. So right now, I'm not gonna, because I'm not affiliated with any apps or brokerages, and there are a couple of them that makes it easy to buy U.S. Treasury, but they're not sponsoring this show. So I would like them to. If you know who you are, one of them starts with a P. You can sponsor the show, and I would definitely tell the people about you. But there are plenty of avenues to go buy U.S. Treasuries. Uh, they sometimes can be difficult. You can buy it directly from the U.S. government on auction, and that could be a little difficult. But a lot of brokerage accounts, a lot of banks and brokers allow you to buy U.S. Treasuries on the secondary market. And so the U.S. Treasuries, like U.S. bond or U.S. bonds, notes, and bills, they are virtually safe. They're not. I can't say 100% safe. I can't because there are some risks, but they're a lot safer than equities when it comes down to securing your principal and getting your interest. The U.S. don't default on their debt; they never have. And if you are in a certain tax bracket, you can do municipal bonds. So let's say you're in, like I'm in the state of Florida where we don't have state tax. So you're in the state of Florida, you don't have state tax. You can buy municipal bonds in the state of Florida. I'm talking about for me, so this is not advice. But you can buy in the municipal income. The municipal bond income is federal tax free. See there? So you don't have to pay taxes on the federal level when you're buying municipal bonds. And if you're at a certain tax bracket, that's beneficial because it'll allow you to collect income without having to pay, that additional tax, especially if you have a lot of income or a lot of, money that is tied up into the municipal bonds. And the beautiful thing about that is, whatever there's a municipality, cities, governments, doesn't matter. You can buy them anywhere in the state. Now, I like the state of Florida because I live here, and therefore, I don't have to pay state tax. So, that's a win for me. But you do have to pay state tax if you add a state that requires you to pay state tax. But a lot of times, depending on the percentages, it might be more conducive for you to go that route instead of, the corporate route, which I'm about to talk about next, which is corporate debt. So like I said, a lot of companies issue out debt. And the thing is, they have to, especially tech companies. Issuing equity is one way, but issuing out debt is another way to, bring in money to use for your company. And the beautiful thing about corporate debt is they pay a higher interest rate than the U.S. Treasury. Well, why is that? So you ever heard of, if you ever watched the movie The Big Short? In the movie The Big Short, they were, banking that the mortgages in a lot of these tranches were going to fall and then collapse the system, which, it happened if you lived in '08. But a lot of these mortgages had a rating system on them. So you had the triple A, the double A, the A, then the double B or the triple B, then double B, and et cetera. So those are a rating system. So like how we have a credit rating system for ourselves, so like our FICO score, companies also have a credit rating as well, and they're just letters instead of a number. So once again, the best is, let's say, the Standard & Poor's, which is the S&P, AAA. So if you're a AAA company, that means you pay your debt. You have a good running with issuing debt and paying it back, and with the interest without no late fees or nothing, or not being late, and et cetera. And that is important because, just like if you have a high credit score, you have a lower interest rate. So if you have a company that's AAA, they're going to pay a lower interest rate when they issue debt. And as it goes further down, the more risky you get, the higher the interest rate. So the thing about corporate debt is, a lot of your favorite companies are not AAA, believe it or not. I hate to break it to you. A lot of your companies are not AAA. So let's say, for example, I own a company and I have their equity. So I own their stocks. I'm sorry. I keep using advisor talk, and I'm trying to not to use advisor talk, so people who are listening who don't know what I'm talking about, they can kind of grasp what I mean. But let's say a company issues out, stocks, and you buy their stock. Well, why not at the same time look into if it fits your, portfolio strategy. If it talk to your portfolio manager and your advisor, why not just throw in some of their debt if the company's good, of course. That way, even if the stock, let's say it's a growth company and it don't offer any dividends, when the stock goes down, if you own some of their debt, you're still going to be getting paid from them. And then, of course, when the maturity date comes, they got to pay you back your principal. And for those who don't know what a maturity date is, it's essentially where the debt comes due. That's where the day that is set that says, "Hey, I will pay you back." Let's say next month. I'll pay you back next month on this day. Maturity date is basically next month on that day. So when I say maturity, that's what I mean. But why not just mix and match, you know, and that way, even if the appreciation comes down or your stock portfolio depreciates, you know, your bond portfolio should level that depreciation out. That way, you're defending your gains, you're defending your equity, and you're allowing yourself to have cash for when the downturn is over. Let's say you got a 6 month stock or 6 month bond from a company that you own. In 6 months, the company could be doing great again, but it's at its lows. So when the maturity happens, you get your interest, you get your principal back, and now you can, recycle it back into the equity if you like it. So there's a bunch of different things you can do when you are having a diversified portfolio, which is, you know, without just having stocks, bonds too. So the three major things that I want you guys to take away from this episode is, one, a diversified portfolio does not mean having all your money in one asset class. So if you have equity and your portfolio consists of 100% equity, your portfolio is not diversified. Hate to break it to you. Even if you have, different stocks and different things and blah, 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 different sectors, it's not diversified. Because the stock market as a whole has systemic risk. And you really can't diversify against that. But you can try to, lessen the burden. Two, bonds might sound like it's for old people, but it's not. If you view bonds, because it is a fixed income asset, meaning, the interest rate is fixed. It's not going to adjust. It's not going to go up and down. The interest rate that's what they're going to pay you in interest. But it's an asset that can be utilized by no matter how old you are. It doesn't people who look at bonds as boring clearly don't know the bond market. So the bonds are one of the most, they have the most, I would say market cap, trillions and trillions and trillions of dollars are in the bond market. And everyday money managers, advisors, very wealthy people, non-wealthy people, everyone uses them. So to demystify that, what's the word I'm looking for? I guess to demystify that notion that, the myth that bonds is for old people and, it's boring. Because right now, earning 5% is great. 5% on something that, you really don't have to watch. Because the thing about bonds is you can just buy them and hold them until maturity. And once they mature, you get your principal back. Now, when they mature, you got to go in and reallocate the money. But that's it. You don't have to really do anything. You don't have to keep up with the news, like especially if you got U.S. Treasuries, because the U.S. government is going to pay its debt. So that's one of the things that, you know, the second thing I want people to stop worrying about is, oh, bonds is for old people. No, it's not. You just don't understand what bonds are. Then the third thing I wanted to mention is diversify even with your bonds. So if you got a certain tax bracket, if you're in a higher tax bracket, the income you get from corporate debt might be, not advantageous because you got to pay interest on it. So, if you, and there's a calculation that they teach us when you're learning how to be an advisor, but municipals are, like I said, free from federal income tax. So you have to do the math. Okay, if I take this lower percentage, but I have free income tax, would that offset if I were to buy this corporate debt with a higher interest rate, but I still got to pay the taxes on that? So that's more of a tax question and something you really got to sit down and talk with your advisors about. But if you're in a high tax bracket, why are you not using all the different avenues to protect your hard-earned income? So yeah, that's pretty much the three that I wanted, or the things I want to talk about. But another thing I wanted to mention is I'm going to try to do some more videos. But I think I'm going to focus mostly on audio at this current moment. So still subscribe to my YouTube. Things are going to be on there regularly, but I really want, because something that I saw earlier this week was, being a podcast, video is great. Don't get me wrong, but podcast is mostly audio. So I don't want to be a person with a YouTube show. I want to, delve into the audio podcast space. And so that's what I'm doing. And the visuals will be just an additional little thing. So I am working on it. I have my setup. I have everything, cameras, everything, lights. It's just, a lot of times I like making these podcasts looking bummy. So that is why if I have to do a video, I got to get all done up, get my hair done, all that jazz. And then sometimes I don't feel like doing all that. So guys, I appreciate you listening again. I really hope I imparted some wisdom. If I did not, feel free to shoot me a message and let me know what I can work on. What would you like to hear? If you have any questions and things like that, just let me know. And I, like I said, I do my best to give you guys the best, essentially. So that's going to be it. I thank you for joining me on another wonderful episode of the WealthWise Show. Like I said, I appreciate you guys. Please subscribe to our YouTube channel. Like us on Instagram, or follow us on Instagram at the WealthWise Show, as well as our, Spotify. Rate us, follow us on Spotify, Apple Music, wherever you listen to our Apple Podcasts, wherever you listen to podcasts. If they have a rating system, if you liked it, give us a good rating. I would greatly appreciate that. And if you're listening and you got a company you want to be on our show and sponsor, I'm happy to oblige you on that as well. So thank you guys for taking the time out to listen to me talk. I appreciate it. And, make sure you guys stay hydrated. Until next time, guys, stay WealthWise. Investment advisory and financial planning services offered through Simplicity Wealth and SEC Registered Investment Advisor. Sub-advisory services are provided by Simplicity Solutions, LLC, a registered investment advisor. Any insurance, consulting, and education services offered through the WealthWise Show. The WealthWise Show is not affiliated with Simplicity Wealth and Simplicity Solutions.